Let's jump right into it. Welcome to The Explainer. Today, we're diving into the wild paradox of Western Digital's recent market performance. Look, we are looking at a scenario right now that is leaving both fundamental analysts and technical chart readers just totally scratching their heads. It's this crazy story of massive growth, the relentless march of AI, and, well, a market that might just be fighting the last war.
So let's start with the big question that's literally on every tech investor's mind. How exactly does a company hit historic, record-breaking gross margins, completely sell out of its capacity for the entire year, and yet simultaneously suffer a massive technical breakdown on its stock chart? I mean, it's a huge contradiction, right? And it's tearing investors right down the middle.
It brilliantly illustrates the tension we're seeing. We've got historically strong fundamentals just colliding head-on with a really bearish technical breakdown. Because, on paper, the business has arguably never been stronger. But on the charts, sellers have completely taken control. So if you're trying to figure out where this stock is actually going, you've got to understand both sides of this battlefield. We're going to unpack exactly what's driving this insane fundamental strength and why, despite all of that, technical traders are currently betting against it. Right at the center of this mystery is Western Digital. Now, they're transitioning their very identity to become the essential storage infrastructure for the AI-driven data economy. They aren't just selling consumer hard drives anymore. They're partnering directly with the world's leading hyperscalers, those absolute giants of cloud computing that literally power the internet. They're building the physical foundation that holds the massive amounts of data required for all these modern AI workloads. Let's start with the sheer scale of this fundamental blowout. Just look at their Q3 fiscal 2026 revenue, $3.34 billion. That is a massive 45% year-over-year increase. We're seeing unbelievable volume driven by this huge surge in cloud computing and AI. And honestly, the most important part, this isn't just revenue growth for the sake of revenue growth. This is highly profitable growth that completely blew past consensus guidance. But what's truly historic here is their gross margin, 50.5% non-GAAP. That marks the very first time a pure-play hard disk drive company has ever breached the 50% mark. Historically, you know as well as I do, the hard drive sector is notoriously cyclical. Margins usually just bounce around between 30 and 40%, and they shrink fast during oversupply. So jumping up by over 1,000 basis points, that's 10 full percentage points year over year, to break that 50% barrier, that is an absolute watershed moment for the entire industry. And they pulled this off by shipping a staggering 222 exabytes of storage in just one single quarter. To put that frankly absurd number into perspective, that includes over 4.1 million hard drives, with some of them as large as 32 terabytes. This kind of massive scale is largely driven by cloud computing, which, by the way, now makes up an incredible 89% of their total sales. They are literally feeding the cloud's insatiable hunger for data. Now, looking at the financials, you really don't have to be a Wall Street analyst to appreciate this incredible jump from Q3 of last year. I mean, look at that non-GAAP earnings per share growing by 97%. Plus, they generated $978 million in free cash flow within a single quarter. This absolute cascade of cash allowed them to just go ahead and authorize a $4 billion share buyback, and on top of that, raise their dividend by 20%. So the crucial point here is why this is actually happening. Basically, the explosion of agentic AI is creating this endless appetite for what we call cold data. That's information that needs to be kept long-term but isn't necessarily accessed every single second. These AI models generate vast amounts of unstructured data, and you just can't keep all of that on incredibly expensive flash storage. You need a massive, persistent, and above all, cost-effective data tier. And that is exactly where advanced hard disk drives come into play. This insatiable demand is exactly what's driving their technology roadmap. By securing long-term hyperscale contracts that stretch all the way out to 2029, they're effectively eliminating their spot market cyclicality. And guys, this is vital. Western Digital's nearline HDD volume is completely sold out for 2026. Because these hyperscalers desperately need predictable capacity, they're signing multi-year agreements. By locking these in, Western Digital is removing the spot market volatility that used to cause those painful boom and bust margin cycles in the past. A huge driver behind this is Hammer technology. This tech allows them to cram 44 terabytes onto a single drive, which dramatically lowers the cost per terabyte for hyperscale data centers. By using localized heat to write data, they're literally pushing the physical limits of density. And they're already qualifying these massive 44-terabyte drives with 4 different hyperscale customers. This is absolutely crucial because it keeps them highly competitive against those way more expensive flash alternatives. Furthermore, their new dual pivot and high bandwidth architectures are creating a totally new performance tier, one that actually matches expensive flash storage speeds without sacrificing any capacity. Remember, flash storage carries a 6 to 10 times cost premium over HDDs, so by doubling bandwidth and sequential input/output speeds, without requiring massive power increases, by the way, Western Digital is successfully closing that performance gap. It makes traditional hard drives the obvious, cost-effective choice for bulk AI data. But hey, in the data center world, it's not just about capacity, right? It's about efficiency. And that efficiency actually earned them a spot on Time's World's Most Sustainable Companies 2026 list. When you're dealing with hyperscale data centers, power and cooling are just massive, massive expenses. So by optimizing their drives for lower power consumption, they're directly reducing operating costs for their biggest clients while simultaneously advancing some pretty critical climate goals. In fact, by increasing storage capacity per drive, they've already achieved a 31% reduction in Scope 3 emissions. That's the carbon footprint generated when their customers actually use these drives. Their ultimate goal is a 50% reduction by fiscal 2030, and they are well on their way. This really matters because it shrinks both their environmental footprint and the footprint of the hyperscalers buying up all their products. Yet, despite all of this phenomenal, fundamental, and operational news, we have a major disconnect when we pivot to look at the stock's actual technical performance. I mean, you'd think a company printing record cash and margins like this would be soaring, right? But the charts, well, the charts are telling a distinctly different, highly cautious story. The charts are showing a pattern called a symmetrical triangle breakdown. It's essentially a glaring technical warning sign where sellers just overwhelm buyers at a key price level, in this case, $624.50. With the Relative Strength Index, or RSI, just sitting there at neutral, there simply wasn't enough momentum to stop the stock from pushing all the way down near $539. The breakdown happened on heavy volume, and without any positive divergence to protect those lows, the stock just surrendered significant ground. Right now, technical traders are looking at a measured downside target somewhere in the range of $584 to $542. In plain terms, traders are basically treating any drop below 610 as a signal to bet against the stock. The market is actively challenging this entire bullish fundamental narrative we just talked about, and they're looking for a bottom to hold or risking a much deeper slide. So let's synthesize all of this. On one hand, we have an incredibly strong fundamental buy case. These multi-year contracts have literally flipped the company from carrying heavy debt to a net cash position. In fact, they recently paid down over $3 billion in debt. They've got record margins, they're fully allocated on capacity for the year, and they have clear visibility all the way into 2029. But on the other hand, the technical risks reflect a market that might still be absolutely terrified of the historical boom and bust cycle of the hard drive industry. Look, the market remembers the pain of past oversupply cycles, and it really seems like technical traders are pricing in a cycle risk that the company's multi-year contracts suggest has already been eliminated. It's a classic battle of old assumptions versus new realities. So we're going to leave you with this final thought today. Has Western Digital permanently outgrown its cyclical past by anchoring itself to the limitless data demands of AI? Or is the market actually right to be cautious of this technical breakdown? As their technology roadmap marches toward 100-terabyte drives, only time will tell if the charts catch up to the fundamentals or if the fundamentals eventually bend to the charts. Thanks for joining this explainer. Keep learning and keep questioning the data.